Hi everyone, welcome back. Training educational session. That's what we're gonna have today, every Thursday. I'm Cuzin. For those of you who don't know me already, I've been trading the markets for the past 15-16 years. In the last 7 years, I've been trading the markets for a living, full time. And I'm here to share with you my knowledge, my trading tactics, trading techniques, strategies, mostly high level trading education. This whole program is powered by Light Forex Broker, and today we're going to dial back. Actually, we're going to start from the very beginning, from the very first step. I'm going to introduce to you the currency market. We're going to talk about the fundamental pricing mechanism of the market, mostly basic stuff. So if you're a beginner, it's perfect for you. But I will also say that if you're an advanced trader, you might find some nuggets, some interesting pieces of information, so you might want to stick around. Anyway, that's what we're going to have today. So, you ready? Let's go. So, when we talk about Forex trading, we also refer to CFDs trading. CFDs, contract for difference, is quite similar to the pricing mechanism in the currency market. However, it's a little bit different. In that sense, it mimics the price of the actual asset. Now here we don't necessarily talk about currencies. What we are talking about could be stocks, could be indices, could be commodities, all those assets which contract for difference. Basically what it does is it reflects the actual price of the asset. However, instead of holding physically the asset itself, what you actually hold is a digital position on that asset. In that sense, you can look at the example we have here. So let's say you were buying an asset that was priced at 500 and it was going up. You were buying it, it was going up by, let's say, 10 points. And at 5.10, you decided to sell the asset. What you would be profiting is the difference, what we call the delta, between your buying price and your selling price, without actually holding the asset physically. And this is where this specific mechanism basically allows for leverage trading. You can actually leverage your position. You don't need to have all the funds to buy an asset, but just a fraction of it. Very simple, right? Let's go ahead and take a look at the currency market. Now, here, you have to remember, in the currency market, we're always dealing with two assets. In this case, two currencies representing, every currency represents a country. And it's always about two currencies competing against one another. This is how the structure of the currency market works. Now, on the left side, you will always have the base currency, right? Where on the right side, you'll have the counter currency. And this is never changed. It's permanent, right? For example, the euro dollar is always constructed like this. The euro is on the left side. It's the base currency, where the dollar would have to be the counter currency. Now, in terms of pricing, it's pretty different from what we're seeing in the stock market, for example. Pretty much everywhere. Only here, you have two sets of price. You have price on the left side, and you also have price on the right side. What is that all about? Well, in the currency market, you have bid price on the left side and ask price on the right side, where basically, whenever you want to sell the euro dollar, the quote that you would be getting would be on the left side. This would be the bid price. In this example here, that would be 106.61. That's going to be your selling price in case you want to short the euro dollar, right? In case you want to close a buy position. This is the price you will be getting. However, if you want to buy the euro dollar, right? In this case, you would have to look at the right side, because the ask price is what you should be interested in. This is the price you're getting. And the difference? Well, the difference, this is what we call the spread. And this is pretty much what goes to the broker, right? To the intermediary party that basically connects you with the market. Now you can see that the difference here between the bid price and the ask price is exactly 3 points, right? Now in the foreign exchange market, we call we call it a pip. So the difference here is exactly 3 pips. But what is a pip? Well, just think about it this way. For every $1,000 position, 1 pip equals 10 cents. And for every $10,000 position, every pip would be equal $1, right? For 100,000 position, it would be $10, and so forth, right? The logic is pretty simple. So let's take this case as an example. If you open 1,000 position, if you buy the euro dollar, right, and you open a position of $1,000, you would pay 30 cents. That's the price, right? That's the difference between the bid price and the ask price on a $1,000 position. Now, let's talk a little bit about the fundamental structure of the currency market. Because if you take the currency market, you can actually divide it into 3 groups. You got the majors, you have the crosses, and then you got the rest of it, right? Because think about it, I mean, the currency market represents all 200 and something countries. So there's a lot of currency pairs. However, most of the trading, most of the transactions happen in one particular group, by far bigger than the rest. I mean, the other 2. I mean, the crosses is also a big group representing solid currencies, very tradable currencies, but the first group is by far the biggest. This is what we call the majors. Now, the majors group is constructed of 8 countries, which are the biggest economies in the world. The United States, Europe, Great Britain, Switzerland, Australia, Canada, New Zealand, and Japan. However, if you take these 8 countries, you can extract 7 currencies out of them. The US dollar always remain in one or the other side, right? But then you begin to cross the rest of the countries between themselves, and you'll find 7 major currencies. Let's take a look at them. Now, even this list of 7 currencies can be divided into subgroups. We got the primary group, which are these 4: euro dollar, pound dollar, US dollar versus the Japanese yen, and US dollar versus the Swiss franc. These are by far the most traded assets in the world, right? Really, most traded assets in the world, not only in the foreign exchange market, that's obvious. Now, the secondary group here, subgroup, is what we call the commodity group. These are the Australian dollar versus the US dollar versus the Canadian dollar, and the New Zealand dollar versus the US dollar. That group is heavily relied on commodities. That's what we call them, the commodity group. But these are the 7 major currencies. So if we have the dollar, the US dollar, in every one of those, what happens if we take out the euro dollar and we begin to cross the other countries between themselves, right? That's where we go to the second group, which is also heavily traded. All of these currencies still represents the biggest economies in the world, right? So, but if you take out the US dollar and begin to cross the other countries here, the other currencies, you'll have 21 more assets. So in total, we have these 7 in the majors group, but we also have these 21. Altogether, 28 assets, both in the majors and the crosses, which is the name of this particular group. Here you can find all the rest of the combinations without the US dollar. And here we can divide it into 4 subgroups. We got the euro crosses. Well, this is the euro against all the other currencies. Pretty simple. The yen crosses, right? All the yen combinations. We got the pound crosses. And we got the rest of the crosses. Everything without the pound, without the Japanese yen, and without the euro. And that's also a nice way to have a correlation analysis. Now, for correlation session, we should expect a session soon about correlation. We're going to have a full session just about that topic. However, right now, talking about the very basic structure of the foreign exchange market, these are the very famous 28 pairs that construct the foreign exchange market, although there are much more pairs, but there are far less traded, more expensive, more volatile, probably less predictable, I should say. If you ask me, I'm mostly focused on these 28 pairs, definitely. And here you can find a nice diagram that shows the representation of these assets within the currency market. You can easily see that there is one currency pair that is far above all the rest, right? This is the euro dollar. Almost 30%, think about it, almost 30% of all the activity in the Forex market belongs to one asset, the euro dollar. By far the most traded asset in the world. Second place is the dollar versus the Japanese yen, which, by the way, that's what makes them so cheap. They are the cheapest currency pairs in the market. Not too far behind, you can find the pound dollar, and then, of course, the rest of the pairs. And it's interesting to see how only 8 pairs, take a look, euro dollar, dollar yen, pound dollar, Aussie dollar, right? USD versus the Canadian, USD versus the Swiss franc, we got the euro versus the Japanese yen, and the euro versus the pound dollar. These 8 currency pairs construct of about 70% of all trading activity in the market. Heavy stuff. Now, obviously, the currency market provides almost unlimited profit potential, really. However, what about the risks? Let's talk a little bit about the risks, shall we? The way I see it, when it comes to risks, there are 4 key elements you want to keep in mind. The first one, and that's no surprise, is leverage, right? This is a very elusive subject. Generally speaking, higher leverage equals higher risk, as simple as that. And if you're not fully equipped with skills and knowledge, you want to keep your leverage as small as possible. You begin to up your leverage as you up your trading skills. That's the equation. Very important factor. You always want to stay on top of your leverage and understand the level of leverage you apply to your trading account. Now, the second key element is geopolitical and economical unexpected events, what we might also refer to as black swan. Now, every now and then, I can't put a finger on a specific time range, but probably every year or 2 years, we have a major event. It could be geopolitical, but it could also be purely economical. And that rocks the market. Seriously, rocks the market completely. It could send prices by 500 and up to 1,000 pip in one day. And this is huge. Now, this puts a huge risk on any trading account, no matter what it is. So you have to be careful with these unexpected events. You always have to be prepared for one of these to hit, because it's not a question of if, it's more a question of when. And this point naturally leads us to the next point, to the next key element, which is a protective stop loss order. Now, I cannot stress this any further. You do not want to have a naked position, a position without a stop loss level, a stop loss order in place. Think about this as your insurance policy. And not only against geopolitical or economical unexpected events, but also on a very daily basis. You can find violent moves, you can find volatile moves. Every now and then, there will be that currency which will go the extra mile, and you definitely want to be covered, right? You definitely want to cover your steps. So this is a very important element. Nevertheless, I think the last point here, the fourth key element, is probably the most important one. Because the biggest risk would have to be trading without proper trading skills, guys. Seriously. You want to make sure that you equip yourself with sufficient knowledge, with sufficient amount of information, relevant information, before you go about and trade your real earned money. So if you're a beginner without trading experience, it would be much safer to begin with a demo account. Now, I think that's a good moment. Just before we leave, I want to welcome you to open a demo account. Try it out. Fill it. I'm going to be here to help you out. I'm going to share with my 15, 16 years of experience all type of educational stuff, all type of tactics, strategies, trading techniques, you name it. So I'm going to be here to help you out through this process. But you definitely need to take the first step. And don't forget, subscribe to our channel, our YouTube channel, Light Forex, so you get all the content, which is almost on a daily basis. You're going to find me every Tuesday and Thursday right there. And don't forget, leave your comments, leave your questions. We want to hear your voice, right? If you have concerns, if you have interesting stories, let me know in the comment below. You'll find all the links below this video. All right, that's about this for this particular session. Forex Market for Beginners, Introduction to Currencies and CFDs Trading. See you in the next session.